Good morning. My name is Mel Bauer, and I'm the program coordinator for the Tax Credit Alliance of Nebraska, also known as VITA program. Welcome to the second video in our financial education series. This video will be covering budgeting part 2 and savings. The information provided in this video is general in nature and for educational purposes only. It is not intended to serve as legal, investment, or accounting advice. The content in this video does not replace personalized advice from a qualified financial, tax, or legal professional. Viewers are encouraged to consult with an appropriate advisor for guidance tailored to their individual situation. Tax Credit Alliance of Nebraska, TCAN, and VITA offers free professional tax preparation through scheduled appointments to qualified individuals. Let's review some topics we will cover in this series. We will go over using your budget to create wealth, tackling common budgeting mistakes, saving and investing are not the same and why, with a breakdown of both, emergency funds and why you need one, 401ks, Roths, and IRAs, and lastly, how to set financial goals. By now, you have learned the purpose for building a budget is to help you take control of your finances. But something that you may not know is that most millionaires and corporations use budgets like a blueprint to bring in more income and build bigger fortunes. The trick behind building a bigger fortune is how you put your money to work for you by using investment strategies that can grow your money faster. Even the best budgets can fall apart if you're unknowingly making some of these common mistakes. Let's break down what they are and how you can avoid them. First, not tracking expenses. Without knowing where your money goes, it is easy to overspend or misallocate funds. How to avoid this? Tracking your expenses. Use a spreadsheet or a digital app. Setting unrealistic goals. Budgets that are too tight or optimistic often lead to frustration and abandonment. How to avoid this? Base your budget on actual past spending habits and make small, realistic adjustments over time. And forgetting irregular expenses. Occasional costs like car maintenance, annual subscriptions, or holiday gifts can bust your budget. How to avoid this? List all irregular expenses and divide them across the year. Set aside money each month into an emergency fund or your savings account. Failing to adjust over time. As your income and expenses change, an outdated budget stops being effective. How to avoid this? Revisit your budget every month, especially after a life change like job, moving, marriage, or a baby. Not budgeting for fun. Cutting out all leisure can lead to burnout and unplanned spending sprees. How to avoid this? Allocate a realistic amount for entertainment, dining out, and hobbies. Relying too much on credit. Using credit cards to cover the gaps in your budget leads to debt and high interest rates, which means increasing monthly payments and barely being able to touch your debt. How to avoid this? Build a small emergency fund and only use credit cards for planned, budgeted purchases you can pay off in full within that month. No emergency fund. Without savings, unexpected expenses like medical bills, job loss, car repairs can ruin your finances for months. How to avoid this? Start by having small goals at first. Ignoring the small expenses. Daily coffees, snacks, or online purchases add up and can eat into your budget and go unnoticed. Review your transactions regularly and track what you spend. Not reviewing your budget often. You might miss overspending or changes in income. How to avoid this? Schedule a monthly money check-in to review your budget and spending. Failing to communicate for couples and families. Disagreements or confusion about money can lead to conflict and financial disorganization. How to avoid this would be set regular budgeting meetings to review spending, set shared goals, and assign responsibilities. It is a great way when everyone is on board. An emergency fund is a dedicated savings account with readily accessible money set aside for unexpected financial emergencies such as job loss, medical bills, or major home or car repairs. You need one to prevent having to go into debt or scramble for money when unexpected events occur. Providing financial security and allowing you to focus on resolving the emergency rather than the cost. Having an emergency fund helps cushion the blow of these unforeseen circumstances, allowing you to recover and get back on track towards your other financial goals. How do you start? Start small with $5 to $10 per week, adding an additional $5 per month. Start with a beginner goal such as $50 to $100 while continuing to change or add throughout the months. Keep it separate from your checking account to avoid accidental spending. Use a normal savings account or a high yield savings account. Easy to access but not easy to touch. Automate $5 to $10 every paycheck to go directly into that account. Cut one small expense, like eating out, and then redirect that money. Use tax refunds, side hustle income, or even bonuses. What are SMART goals? SMART stands for specific, measurable, achievable, realistic, and time-oriented. The idea behind using SMART goals is to create a format to help you meet your financial goals. Using SMART goals as a format can be a powerful tool for setting and achieving your budgeting goals. This will help you see and measure your progress along the way. Framing your goals this way gives you a much better shot at reaching your goals. Start by coming up with your own SMART goals and write them down. Be specific, clearly defining your goal. Skip the vague statements like, save more money, I want to be rich. Instead, specify and make them crystal clear. Think about what you want to do with your money and add details with specific goals and definite dollar amounts. What do you want to achieve? Are you saving for an emergency fund, a down payment on a home, or to pay off a specific debt? Saving a car becomes buy a Ford Explorer between 2010 and 2015 for under $9,000. Save for a vacation becomes 2 weeks across Europe next summer, visiting 5 different areas for $8,500. Adding these details helps bring the goals to life, making them feel more like something you can really do. Let's talk about great ways to keep you motivated when you're trying to reach your financial goals. One of my favorite tactics to introduce is by measuring your goals to see the progress. Hear me out. Without a clear way to measure your goal, it's easy to get frustrated and give up. A great way to implement this would be to create a little visual chart with many little goals. Actively measuring your goals helps you stay on track. Some good ideas for measuring your goals could be like create a vision board, a printable tracker like the thermometer you see on your screen, a chart, financial apps, or even spreadsheets. Achievable and realistic goals are so important in order to meet your goals. They have to be possible. That means both achievable and realistic. If they're not, you'll likely fail at meeting them, which will quickly derail your motivation. Maybe putting $100 per month into savings doesn't work for your situation, but $50 per month is something you could do. Make sure the goals that you set can fit into your budget with ease and without crowding out any necessities. Your goals should be based on your current financial situation. As you begin to bring in more money or have more money and work to control unnecessary spending, you'll free up even more space in your budget. This will allow you to set bigger goals that you'll have no trouble reaching at all. Set a time frame and break the goal down into smaller steps, like this. Buy the used Ford Explorer for under $9,000. Your goal could be to buy the Ford Explorer within the next year, and in order to do this and get $9,000, you would take that $9,000 and divide it by 12 months. That's around $750 per month. Then you can divide this number by how often you get paid. Let's say you get paid bi-weekly. So that would mean out of each paycheck, you would have to put $375 into your savings for 12 months to reach this goal. If you measure your goal and realize this number is too high for you, that's when you can adjust your goal accordingly by either extending your goal beyond the 12 months or looking into a cheaper alternative for a vehicle. Figure out what steps you need to take in order to reach your goal. This allows a framework for you to follow, so you can actually get started and stay on track. Cross off each mini goal and big goals you accomplish, and with time, you'll see huge progress you've made. This will encourage you to keep going. People often use savings and investing interchangeably, but they are not the same thing. Savings is the act of setting money aside for a specific purpose, usually for a short-term goal or an emergency fund. The primary goal of saving is the preservation of capital, meaning you want your money to be safe but easily accessible. Savings is low risk, and your money is typically held in accounts insured by the Federal Deposit Insurance Corporation, which protects your deposits up to a certain limit. This is for short-term goals, typically 1 to 5 years. You can save for things like a vacation, a down payment on a car, an emergency fund, or to cover unexpected expenses. Investing is the act of putting your money to work or planting a seed by purchasing assets with the expectation that they will grow in value over time. The goal is to build for long-term financial goals, such as retirement, a child's education, or buying a home many years in the future. Investing involves a high risk. The value of the investment can fluctuate. You can lose all or some of your initial capital. Investing is really best for long-term goals, typically 5 years or more. This allows your money to take time and recover from the market downturns and benefit from the power of compound growth. A balanced financial plan will include both savings and investing for short and long-term goals. Focus on savings first. Creating a nest egg is the first part of this plan, directing your dollars exactly where you want them to go rather than spending them on things you really don't need. As Warren Buffett says, do not save what is left after spending. Instead, spend what is left after saving. Saving guarantees that you'll have money when you need it. Every dollar that you put into savings is a dollar that you will get back. By beginning with savings, you will be able to build up some cash, including some extra to invest with later down the line. First, meet your goal by creating that emergency fund, saving for that car, or paying down that debt faster. The discipline of saving teaches you to live within your means and to set aside a portion of your income consistently. This is a fundamental habit that you must develop before you can successfully invest. If you don't have a surplus of income to save, you won't have anything to invest later down the line. Building up a savings cushion provides a sense of peace and security. Knowing that you have money set aside for emergencies reduces financial stress and gives you the confidence to take on other financial goals like investing and not having that constant fear of setback. Did you know that when it comes to creating a savings account that you have options? There are several different types of savings account, and today we will go over and talk about each one of them. The traditional savings account. This is a basic bank account where you can deposit money and earn a small amount of interest. It's a foundational tool for managing your personal finances. You should start with the traditional savings account because it's a safe and simple way for you to begin saving your money. This is also the ideal place to start to build that emergency fund. Some pros of having a traditional savings account is funds are insured by the FDIC up to $250,000 per depositor. Most savings accounts are at a physical location so you can easily access your money through an ATM, a teller, or online transfers. There are generally no complex rules to having a savings account, making it easy for beginners to use and understand. Some cons of having a traditional savings account is the interest earned is usually minimal and offers very little opportunity for your money to grow. Some banks may charge monthly maintenance fees if you don't meet a minimum balance requirement. When should you consider a different savings account? You should consider moving to a different type of savings account once you have a solid emergency fund established and are looking for higher returns on your money while maintaining low risk. Let's talk about a high yield savings account. A high yield savings account, also known as HYSA, is very similar to the traditional savings account, but it offers a higher interest rate. While most of the fundamentals are the same, the key difference is how your money grows. Some pros of having a high yield savings account is they do offer that higher interest rate. And like traditional savings account, they are protected by federal insurance, ensuring that your money is safe up to $250,000 per depositor. Your money is still easily accessible, and you can still transfer funds quickly when you need them. Some cons of having a high yield savings account are the interest rates are variable, meaning that it can go up or down based on the market conditions and the Federal Reserve's actions. Many are offered by online-only banks, and this can mean a lack of physical branches for in-person banking or cash deposits. Some may also have a minimum balance requirement to earn the advertised high interest rate, or have a certain requirement for a balance to avoid monthly maintenance fees. There also may be a limit to how many withdrawals you can do in 1 month. When to consider a different savings account? The main reason to move from a high yield savings account is when you have built up a fully funded emergency fund and a cash reserve for a short-term goal. At this point, you should consider other options for your money that offer even higher returns for a different purpose. Let's get into the money market account, also known as the MMA. This is a type of savings account that often combines the features of a traditional savings account and a checking account. While the name does sound intimidating, it is safe and federally insured deposit account, not a direct investment in the stock market. Why does someone generally start an MMA? These are great options for a few reasons, especially if you have a significant amount of cash to save for on a short-term goal. They offer a better interest rate than a traditional savings account, and they also can come with check writing capabilities or a debit card. This offers more flexibility than the standard savings account. This makes a good place to keep your money that you may need access to for larger but not day-to-day expenses. Some pros of having a money market account are they generally offer higher interest rates than a traditional savings account, and most MMA accounts offer features like check writing and debit cards. Some cons of having a money market account are they generally require a high minimum balance, often in the thousands of dollars, to open the account or to avoid monthly maintenance fees. While you may have the check writing capabilities or the debit card access, there are usually limits on the number of withdrawals or transfers that you can make per month. And like the high yield savings account, interest rates are variable and can fluctuate with the market conditions. An MMA is an excellent tool for specific short-term to mid-term goals, but it is not the best solution for every financial situation. A certificate of deposit, also known as a CD, is a type of savings account that holds a fixed amount of money for a fixed period of time in exchange for a high interest rate. When the term ends, the CD matures and you get your initial deposit back plus the interest that you've earned. Why would you use a CD? You would use a CD to save money for a specific goal with a predetermined timeline, such as a down payment on a house, a wedding, or college tuition. Some pros of a CD are the interest rate is fixed, so you know exactly how much you will earn by the maturity date. CDs often pay higher interest rates than other savings accounts because you are committing your money for a set period of time. Some cons of a CD are that your money is locked away for the entire term. If you need to withdraw the funds before the CD matures, you will face an early withdrawal penalty, which can be a significant portion of your earned interest and in some cases your principal. You generally cannot add more money to the CD after the initial deposit. To add more funds, you would need to open a new CD. Let's talk about a health savings account, also known as HSA. This is a powerful tax advantage savings and investment account specifically for healthcare expenses. It is unique because it offers triple tax advantage. That makes it one of the most effective long-term saving tools available. Why would you use an HSA? You would use an HSA to save and pay for current and future medical expenses with significant tax benefits. It is particularly useful if you are young and healthy and can afford to pay for routine medical care out of pocket, allowing your HSA funds to grow over time. The money in the account can be used for qualified medical expenses for you, your spouse, and your dependents, even if they are not covered by your high deductible health plan. When to use an HSA? You are only eligible to open and contribute to an HSA if you are enrolled in a high deductible health plan. A high deductible health plan is a type of health insurance plan that has a higher deductible than a traditional plan, but often comes with lower monthly premiums. This is the key requirement. If you are not enrolled in an HDHP, you cannot contribute to an HSA. You should consider an HSA if you are healthy and have a low number of anticipated medical expenses, and you are enrolled in an HDHP and can afford to meet the deductible if an unexpected medical event occurs. Some pros of an HSA are contributions are tax deductible. The money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. The HSA belongs to you, not your employer. You can take it with you if you change jobs, switch health plans, or retire. HSA funds roll over from year to year. You never lose the money that you put in. Many HSA providers allow you to invest your funds in stocks, bonds, and mutual funds, giving you the opportunity to grow your money for decades. Some HSA cons are they require a high deductible health plan. This can be a major con for people with chronic conditions or those who anticipate frequent medical needs, as they will have to pay more out-of-pocket costs before insurance kicks in. If you withdraw funds for non-medical expenses before age 65, you will have to pay income tax on the withdrawal and a hefty 20% penalty. After age 65, the penalty is waived, but you will still pay income tax on non-qualified withdrawals. There are annual IRS mandated limits on how much you can contribute to an HSA, which are often lower than other retirement accounts. And some HSA providers charge monthly fees for maintenance, investments, or transactions. How can I get an HSA? Check your eligibility. The most important step is to confirm you are enrolled in a qualified HDHP. The IRS sets specific minimum deductible and maximum out-of-pocket limits each year to qualify. You also cannot be enrolled in Medicare or be claimed as a dependent on someone else's tax return. Do you know the difference between a 401k, a Roth, and an IRA? Let's talk about IRAs. IRAs are individual retirement accounts, a tax advantage investment account designed to help you save for retirement. It lets your investments grow over time, either tax-free or tax-deferred, depending on the type. There are two main types of IRAs. There is the traditional IRA and the Roth IRA. The traditional IRA is considered tax-deferred. You contribute money to the account before taxes are taken out. Your contributions may be tax deductible, which lowers your taxable income for the current year. The money grows tax deferred, meaning you don't pay taxes on investment gains as they occur. You pay taxes on your contributions and earnings when you withdraw money in retirement. This is best for people who believe they are in a higher tax bracket now than they will be in retirement. The upfront tax deduction is valuable, and they expect to pay a lower tax rate later. A Roth IRA, you contribute money to the account after taxes are taken out. You don't get a tax deduction for your contributions. The money grows completely tax-free. When you withdraw the money in retirement after meeting certain conditions, both your contributions and all of the earnings are completely tax-free. This is best for people who believe they are in a lower tax bracket now than they will be in retirement. By paying taxes now, they are hedging against the possibility of higher future tax rates. It is also beneficial for those who want to avoid required minimum distributions, as Roth IRAs do not have them. Also, they have income limits and phase out starting at $150,000 for single filers and $236,000 for married couples filing jointly. These limits are updated yearly, so depending on when you are seeing this video, please visit Google to verify these amounts. If you exceed the income limit, you cannot contribute to your Roth IRA. Let's talk about the 401k. There are three terms that can be confusing because they describe different aspects of retirement savings. Let's break down some of the differences. 401k refers to a type of retirement plan offered by an employer. Roth refers to the tax treatment of the money in the account. Roth 401k is a specific type of account employer-sponsored plan that combines the features of a 401k with the Roth tax treatment. A traditional 401k is an employer-sponsored retirement savings plan that allows employees to contribute a portion of their pre-tax or after-tax Roth income towards retirement. These contributions are typically deducted directly from an employee's paycheck and may be matched by the employer. The money will grow until retirement, but the benefit depends on the contributions and investment returns. This is the most common type of employer-sponsored retirement plan. Only employees whose employers offer a 401k plan are eligible for this. You contribute money from your paycheck before taxes are taken out. This lowers your current taxable income, potentially reducing your tax bill for the year. Your money grows tax deferred, meaning you don't pay taxes on the investment gains as they happen. You pay income taxes on withdrawals in retirement. The IRS sets annual contribution limits for 401k plans. In 2025, the limit is $23,500 with an additional $7,500 catch-up contribution for those 50 and older. Employer matching is a major benefit. Many employers will match a percentage of your contributions, which is essentially free money. A Roth 401k is a feature that some employers have added to their retirement plans. It takes the after-tax or tax-free treatment of a Roth IRA and applies it to a 401k plan. Only employees whose employers offer a Roth 401k option will be eligible for this. Like a Roth IRA, you contribute after-tax dollars and the money grows completely tax-free. You pay taxes now on your contributions, but you pay no taxes on qualified withdrawals in retirement. It follows the higher contribution limits of a traditional 401k, $23,500 in 2025, and does not have the income limits of a Roth IRA. If your employer offers a match, those matching funds will go into a separate 401 traditional account. You will have to pay taxes on those employer match contributions and their earnings when you withdraw them in retirement. Some 401k plans allow for loans, and there will be limited exceptions for early withdrawals due to hardship. In summary, the choice between these two accounts comes down to your employer situation and your belief about future taxes. A 401k is an employer plan with a pre-tax contribution. A Roth IRA is a personal account with after-tax contribution. A Roth 401k is an employer plan with after-tax contributions. Let's talk about 401k and the 457B. The 457B is a savings plan primarily offered to government employees, state and local government officials, public school teachers, county and city employees, and first responders. By contrast, these retirement plans are usually offered by private enterprises. 401k plans are qualified retirement plans, which means they conform to the laws established by the 1974 Employee Retirement Income Security Act. Those laws ensure private employers offer the same 401k retirement benefits to all employees. A 401k drawback is the restriction on the withdrawals. The IRS will impose a 10% penalty for 401k withdrawals before age 59 and a half, with only a few exceptions. A 401k also allows for matching contributions from the employer. Employers will typically offer to match a certain percentage of an employee's salary if the employee contributes a certain amount to their 401k plan. 401k matches can add up to a meaningful portion of compensation, especially as you earn raises. The 457 plans are not qualified retirement plans, so they play by slightly different rules. Since a 457 isn't subject to Employee Retirement Income Security Act laws, withdrawals before age 59 and a half are not subject to the 10% tax penalty imposed on most early 401k withdrawals. That makes it easy to access your funds if you retire earlier than usual. Unlike 401k plans, employer matching contributions are extremely rare with the 457B plan. Most government entities offer employees a pension which acts like an employer contribution. The 457 is seen as a supplemental saving plan for employees, enabling them to save more if they want. If an employer does offer a matching contribution for a 457, that amount will count towards the employee's annual contribution limit. 457 plans also offer generous catch-up contributions. If an employee is less than 3 years away from normal retirement age, as defined by the plan, they can contribute up to twice the standard annual contribution limit. Here is some information on some of our resources and how to access past newsletters. By visiting our website at tcan.unl.edu, you can find a ton of information on our financial education series. Start by visiting the Financial Education tab on our website. You can see it highlighted by the white arrow on your screen. And under the Financial Education tab, you will see 3 choices. To see past newsletters, you want to select the Newsletter Archive section. To find our previous videos and downloadable resources, you will want to visit the Newsletter Topics section. Feel free to follow us on social media. If you click the hyphenated links underneath each logo, it will take you directly to our social media pages. If you have an idea for future topics for financial education or any questions, please reach out to us at vita@unl.edu or give us a call at 402-472-0857.